So this talk is going to be a little different from the afternoon in the sense that through the afternoon and up until now, I think the presentations have been by the companies and by the startups. My talk is going to be aimed at these startups. It's aimed to the companies here and the founders in the audience and the investors in the audience. So I'm going to talk a little bit about this strange creature called venture debt and just explain through a story, giving an example of a company that we've dealt with, how it works, and so on. Just a little bit of background on myself. So I started the company in about 8 years back. So I was with Citibank for 12 years, and somewhere towards the end of that, I had an epiphany moment in my life about venture debt. And to me, it was the perfect combination of being able to work with startups and using my skill sets as a lender, as a banker. And so I started doing venture debt at Citi. It was a one-man business, just myself. So I did everything from negotiating deals to originating transactions to documentation and closure because, well, nobody else wanted to take a risk with their career and do something as harebrained as lending to startups. And so I ran that for 2 years, and then I left Citi to start up a venture debt business called SVB India Finance. And we took the company through a buyout earlier this year with Temasek as the investors. We are now moving the platform from what is essentially an India-focused business to one that's focused across the region. So we're looking to set up business, InnoVen capital across Asia. We'll be looking to set up our business in Singapore and Southeast Asia over the course of the next month or two. And our focus is going to be to work with VC-backed startups and early-stage companies in the region. So I'll talk about a little bit about venture debt. So theoretical definition really is it's any form of financing that's available to a company that's still dependent on venture capital. Very simply put, it's financing in the form of debt as an alternative, or I shouldn't say alternative, but in addition to the equity that companies raise through a venture capital round. Traditionally, companies have had, early stage companies have not had too many alternatives to financing their business growth other than selling equity, right? So you have a seed and angel round, you have a venture capital round, and several Series A, Series B, Series C, and at each stage, essentially, you're parting with a certain amount of your company to raise capital to grow. What venture debt does is essentially it's a form of additional capital that you raise along with your equity that helps you to raise more capital and not dilute as much equity. Okay, so it's a form of financing that's structured as debt that goes along with the equity. So if you think about the company's life cycle, and sorry, it's a little bit of a busy slide, but this is the best way I could use to describe it. If you think about the extreme left, which is the seed angel round, and the red line really is just as companies scale through, right? Companies walk the valley of death. When you start up a company with an idea, you have the first few tens of thousands of dollars, you have a concept you want to really build, and you spend the time and effort really building out the first fundamental foundations of the business. And it's at this stage that 95 or 98% of the companies, take a pick, percentage of companies die. It's a few companies that really scale through the valley of death and then grow to a point where they start raising serious amounts of angel capital, seed capital, and so on, and then really start building up their business and scaling up their business. So at that point, really, you're looking at seed capital as the form of financing. As the company sort of goes to Series A and breaks even and goes to Series A, that's when you get the VC funds in. You raise your first institutional round, maybe $3 million, $4 million. And at each subsequent level, Series B, Series C, the theory is that you will raise more and more capital at less and less dilution because you're getting more and more valuable in the process. Till such point as when you get to a growth or late stage, that's when you start attracting private equity investors. At that stage, you're really looking to finance scale up rather than venture risk. Investors are looking to take sort of growth risk. You then start raising 30, 40, 50, $100 million of capital. And at some point, you become a mature company, you go list, or you get acquired. And that's kind of the public market side. So most lenders really are in this little red circle here, or red oval here, which are focused on companies that are profitable, that have an established track record, that are large, perhaps a few $100 million in revenue and so on. The space that we play in venture debt is bottom and to the left of that, which is early stage companies from the time they raise a Series A, right? This flies in the face of logic. I mean, I remember when I first proposed this in Citi, my credit guy took me aside and said, Ajay, why do you want to mess up a long career that you've had at Citi by proposing a harebrained idea like this where you lend to startups? That may be true, but there's a certain set of circumstances that enable a lender to safely lend to early stage companies, right? And I'll get to some of those, but essentially the takeaway from this slide is venture debt is essentially about financing companies that are early after they have raised a Series A institutional round. What Series A means varies for everyone. For us and for most venture debt providers, a Series A is the first institutional round that you will get, let's say a minimum of $3 to $4 million of venture capital money, right? Sorry, going back. This is just an indication of the kinds of companies that we've funded so far. If this was an India audience, everyone would have gone, it's great companies you have there. But I'll take this silence as being awe. So these are a whole bunch of companies. Really, the only reason to put this up here is just to illustrate the fact that there's tons of these companies that are cash burning, that are heavily loss-making, that have no valuable collateral. And they're across the spectrum of industries. They range from companies that make Fasos, right there in the middle is a company that makes wraps and rolls. There's a company that does quick service restaurant. There's a company that has medical devices. There's companies in solar. There's also companies in e-commerce. And so the joke was in our office that we finance everything from silicon chips to potato chips, right? This is slightly different if you go to the US and markets where venture debt exists and has existed for 30 years. And if you looked at the portfolio of companies that do venture debt in the US, you will see that those are largely just technology companies. So companies built around a core of technology or IP, right? Companies in India are very different. They're not necessarily built around technology, but they're built around innovation. And so you have several companies that are built around drivers that have nothing to do with technology. But they could be the first mover advantage. They could have a unique database. They could have a unique process. They could have a fabulous team. And I'll come to the fabulous team concept as a very important differentiator in how a business is built when I take the example, the case study that I've got. So what are the typical debt terms? It's a debt instrument, okay? By and large, this is a debt instrument. It's a typical term loan that you'd get, ranges up to 3 years, sometimes a little bit longer, 3 to 4 years. It carries an interest rate, which you have to repay along with the loan principal. The interest rate, everyone asks me, what's the interest rate on the loans? The interest rate is pegged to where it would be available for regular small and medium enterprises to get term debt in the market. And every market is different. In the US, SMEs can get term financing if they can get it at perhaps 7, 8%. In India, they can get it at 13, 14, 15%. In Singapore, it may be 7, 8, 9%. So in every market, we look at what the equivalent rate would be that an SME can get, and that's where we peg ourselves. The idea is, again, there's a small equity warrant component that ensures that we get some upside if the company does well. And that is really to help us on a portfolio level get the returns back that we expect by lending to, quote unquote, a risky segment like startups. Right? But the important part is that we take out the upside potential that we have, and we park that in a warrant. And we said, you know what, we won't take this warrant upside as long as the company has not got an exit. So whenever in the future, and that could be 7 years out, 8 years out, 10 years out, the company gets an exit, goes IPO, gets acquired, when the investor makes money, when the founding team makes money, that's when we make a little bit of money. If the company never gets acquired, never goes IPO, never has an exit, all we get is our interest and our principal back, right? Again, senior security over borrowing companies' assets. We are not fussed about the value of the collateral you have in your business. What we are fussed about is being senior secured lenders, because that gives us rights under creditor rights when we need to, take it forward in the sense when the company goes into distress. There's no restrictions on end use. We do not, unlike banks, we do not mandate what you need to do and what you cannot do with the funding you get from us. So banks typically have restrictions on what you can use their loans for. We don't restrict it. Our understanding is the company knows better the company knows much better what it can do with its money than we can tell them what to do. So our role is to assess the company, give them the capital to run the business, and then let them run it. And finally, there's no personal guarantees from promoters. This is a big thing in India, right? Every bank will ask for promoter guarantees, and we don't, because our philosophy is that companies are started by people who are entrepreneurs, who have passion, may not necessarily have the capital to provide guarantees. And for us, it's taking the assets of the company that's fair game and not the promoter's personal assets. So why venture debt? I mean, this is pretty obvious, I think, by now. One is that it just gives the company access to a lot more capital to play with, to achieve milestones and better metrics, in addition to the equity. The second is it extends cash runway, and I'll explain these benefits through the case study, and minimize equity dilution. So let's take the case study of this company that I have hidden. It's called Atom, and I don't want to talk about the name because there's some information that the company wasn't comfortable with us sharing. So this is India's first ATM company, management company. Now here's what the uniqueness of this company was. It didn't have any technology that was so great. What it did have is a team that literally created the ATM industry in India going back 2 decades. And this is a team that stuck together and created NCR machines and created Euronet, and then created this company as the next sort of step forward for the team. So for us, any business that wanted to play in the ATM space in India, there was no option but to have this team. And you could not build a competing business in the ATM business if it wasn't for this team. So for us, having the team was itself a great value driver and a great differentiator in the marketplace. It was then acquired by a large Japanese electronics company last year for an undisclosed amount. But if you look to the left, some of the metrics there of the company, right? So it had started revenues in 2008, and actually 2008 revenues were only there because it acquired a small ATM maintenance company. So these companies' revenues were 0 to begin with. They were still 0 in the second year, but they acquired a maintenance company, which is why they had flows of $1.5 million. They were loss-making, by the way, and they continued to be loss-making for the next 3 years. They went through a Series A with a venture capital investor of $4 million. That was tranched as 4 and 2, and then they subsequently raised equity. So what we did in this case was we provided them with a venture loan on these terms in February of 2008, right alongside their Series A. And actually, by the time this closed, and this was actually our first deal that we did in the market, it was December 2008. So it took us a good 10 months to get comfortable with our first loan and get the structure up, get the approvals done, and get the loan to actually be drawn. So this was it. With the $4 million equity, we provided $1 million of debt. It was a 3-year loan, 12.5% interest rate, 1% transaction fee, and we took those warrants that I mentioned to you guys earlier. We took warrants for about $200,000, pref shares, and that gave us, at that point of time, roughly a 1.4% ownership in the company. The same amount of money if the company had raised through equity would have been a lot more dilutive, and I'll share that with you. So the left chart is really the chart that talks about, so the red bars on this are really the company's net cash burn every month, and the little spikes in the middle are the special project that they had to invest in to create a back office that would do the net settlement of ATM payments across India. So they needed to put a back office in place. The regular burn started about $200,000 a year, but slowly going up. The middle bars were really what they needed to spend on to get a back office in place, right? So the equity that they raised of $4 million, which is the little star on the left, that burnt down, right, every month on month to the extent that they paid out cash. So the burn here, the red bars are expenses minus income, right? So there was a net burn, and so the cash sort of, kept getting burnt month on month. If they had followed this trajectory with no other financing in place, they would have hit rock bottom in April 2009, right? They would have run out of cash in April 2009. What did they do instead? They took debt from us of $1 million, which is why you see that little spike of the star there. That's when we provide the debt. That gave them an extra 4 months of cash. So now they only ran out of money in August of 2009. That's 2009, which is why they did it. So they were able to do a couple of things with this. One is that they were able to push out the burn, hitting ground zero from April to July, August, which gave them extra time to hit, have the ability to say we've spent and we've built the back office, and therefore now the round coming in would be at a much better valuation. And two is that gave them extra time to actually spend that money, extra money to actually build that project out. Right? So in a sense, it extended cash runway for them, and it helped them improve their valuations. What did it do to equity dilution? And the slide on the left is the way that they would have been had it not been for venture debt. Right? This is the way that their ownership would have been at the end when they got acquired by this Japanese company last year. And because they did venture debt, you had that little sliver of InnoVen capital. You can see that 0.9%. That was the ownership. It came down from 1.4 to 0.9%. But look at the founding team ownership. It went up from 48% to 54%. So that is the saving to the founding team. So let me put it differently, right? Because the company was able to take venture debt instead of increasing their equity dilution by 1 million more, because of that, they saved themselves dilution of roughly 190,000 shares, which meant that when they exited, the founding team and the investors collectively saved $20 million worth of dilution. This is $20 million of cash that actually went into their pockets because they did venture debt and because they saved themselves dilution. Right? This is the value that venture debt has. It can help you to extend your runway without diluting as much equity, improving your valuations, and therefore resulting in a much better outcome for the team and for the investors when there's finally an exit event. So there's a catch, right? What's the catch? The catch is, as I think I mentioned that once earlier, a company has to be VC funded for us to start doing venture debt. And the minimum starting point is $3 to $4 million of venture debt, or venture capitals, pardon me, right? So if you look at this, this is kind of a filter of how we look at deals. So the first and most important filter is there a top-tier venture capital fund that's invested in there? And the reason for that is, I think, a little obvious. Take bets on investors that really know how to invest and to harvest those investments. And when they are successful, so are we. But the other reason is equally important in that we do not take board seats. We do not take observer rights. So having a VC in the company at the board level, in a sense, is helping us through proxy. Right? We know we have a trusted friend at the board level that's managing the company and helping the company navigate through its minefield of growth. And in the process, as they're helping themselves, they help us too. And oftentimes when companies go into distress, and I can tell you there's lots of times that companies do go into distress because these are, at the end of the day, early stage companies. And these are companies that are the growth stage and they go through their growth pains. When things go sideways, and almost every company has a quarter or two that things go sideways, that having someone with a close relationship at the board level really helps us to understand the true picture of what's happening inside the company and therefore gain comfort from that. Right? Look, everyone wants to be honest when things are great, but not a lot of people are honest when things are going not so great in their companies. And having an honest voice inside the company that tells us what's happening and how are things being addressed really helps us. Because in companies at an early stage, there is no exit button. If things go bad, you cannot hit an exit button and say, I'm going to get out of here. There's no cash in the company. You have to learn to walk through a distress situation rather than walk out of it. And having a VC at the board really gives us that comfort. And I can tell you there's innumerable examples over the last 8 years, actually 10 years since I've been doing it at Citibank, where investors have often told companies, when you talk to them like you're talking to me. So talk to InnoVen Capital and talk to Ajay the way that you would talk to me when I'm at the board. There's complete transparency. There have been situations when I've been a subordinated lender. For those of you that need to be explained that a little bit. So there are times when we come into a company when there are other senior lenders and we are subordinated to them in terms of cash flow and security. There has been at least one situation in the recent past where the company has gone to distress. There hasn't been enough capital. And the investor has prioritized the company's repayment to us over that of the senior lenders. So the senior lenders have been stopped being repaid, but they continue to repay us, because they see us as being special partners for them. They see us as being the providers of patient capital that give them freedom of using the capital the way they want and being able to really add value to their businesses. So being backed by a top-tier venture capital firm is absolutely essential for us. There's no deal if there isn't a VC. Strong enterprise value, and again, I think enterprise value for us is the sum total of the value of the business beyond whatever is there in cash and collateral in the company. And the factors that add to enterprise value are unique in intellectual property, or unique brand, or a process, or a team, as I explained to you earlier. It could be any number of factors that really drive differentiation in the marketplace for this company we've lent to, and the basis on which the company grows and matures and remains profitable and eventually goes and becomes a big, valuable company. So recent round of VC financing, the more liquid the company, the more comfort we have to add to it and give the company more liquidity. Solid senior security, I think I mentioned this. We're not fussed about the value of the collateral. We just need to make sure that we're the senior secured lenders here. And last is the team, certainly not the least. And as the old adage goes, that investors fund teams and not ideas, is also true for us, because, and someone referred to that in an earlier panel where they said that, it's all great when it's ideas, but you really need the team to step up and execute. That's where a company becomes valuable. So just comparing it to bank debt, I think I've gone through this earlier, and this slide is pretty explanatory, self-explanatory. Basically, it's, bank debt is not available for a company unless it's large, unless it's profitable, it's got a track record, unless the founder is willing to give personal guarantees and so on. Our debt is relatively light in terms of the impact on the company. So just 2 or 3 thoughts of, what our clients are saying. And I thought this was important just to give a sense of how they perceive it, and not how I talk to you about it in a theoretical sense. And here, Snapdeal is basically saying that, we really understand their business. We really take time to spend and understand what they do, which is very unlike most lenders do. Most lenders don't really want to know your business. They want to look at your financials and don't want to understand it. And the point to that is when the company goes through trouble, you understand why it is going through trouble and what can happen to bring it back to life. This is again an Apps Daily runway extension. And the third really is just about preserving equity and increasing value. So the point here is, I think venture debt is here to stay. We are bringing venture debt to the region. We should be up, as I mentioned earlier, in the region in the next month or 2. We've been doing this in India, so hopefully some of those best practices, we will be able to bring those to us and with us as we come into the region here. So happy to chat with you after this session. Just find me out and we can have another, an extended conversation. I can talk all day on venture debt, by the way. So never tired about speaking about it. That's all from me.